The standalone business was expected to post a decline because of the exit from fertilizer and agri-inputs business as well. How was industrial chemicals in North America, Europe as well as Africa as a geography?
So overall, if you look at the segments we are in, which is the continuing business part of it, we have first time reported three segments, which is the basic chemistry businesses, the specialty and the consumer business. If you look at the trend in the basic chemistry business, the trend has been in terms of profit almost flat. This is despite the energy increases which we have faced, and we've been able to pass on maintain our margins despite the increase in costs, mainly because of strong demand conditions. As far as the consumer business is concerned, it's tracked a growth of about 33%, and the specialty business has tracked a growth of 25%, and that has led to overall margin being slightly better than last year on a standalone basis, and almost similar on a consolidated basis of 19%.
Right. So what was the average capacity utilization in the soda ash business, and do you see prices stable given the supplies from Turkey and any impact from the US-China trade conflict?
In a sense, the chemical business continues to remain on a bit of a strong wicket because of the strong demand. The demand-supply situation is fairly tight, and we expect that to continue going forward on the back of pretty strong consumer and the consuming sector demand. So as far as the new capacities are concerned from Turkey, we don't anticipate any major shift in the demand-supply situation. So we are fairly upbeat on that business in terms of holding its ground on margin as well as the capacity utilization right throughout and going forward. And in terms of the consumer business, as you know, we are clearly focused on growing that piece, and that business should continue to trend and clock forward on the back of various investments, both in new product categories and investments in the marketplace, which we've been doing. And the specialty business, as you know, we've already committed 500 odd crores of investment, of which half of that investment is coming up in Nellore, which is the plant is on schedule for launch of nutraceutical product, and another half of that investment is being invested in Cuddalore, where we've acquired a unit called Allied Silica for our silica business.
Right, updates us on the commissioning of the HDS plant and the revenue contribution seen from it.
Broadly speaking, both these units should be giving us revenues in the region of approximately 1.5 times the investment. So we expect in the initial phase, when they are fully utilized, it will be anywhere between 750 to 1,000 odd crores of revenue. And these businesses are pretty much on track to get implemented, and then it is a scale-up which we are looking forward to.
Right, we were expecting proceeds of 375 crores from sale of assets to come in the quarter gone by. What's the net debt position and the pay down roadmap, so to speak?
So our net debt is down to, on a standalone basis, we are net debt free. We've got a net cash position of about 2,800 odd crores, close to about 3,000 crores, and on a consolidated basis, our net debt position about 1,500 odd crores. And that's broadly the position. There's about 4,000 odd crores of cash on the books.
What capex have you drawn for FY19? Earlier you had marked something for ramp up of consumer pockets like salt and nutraceuticals.
So in terms of the capex plan, this year we would be, our usual capex is about 500 odd crores. This year it may be slightly higher, between 700 to 800 crores. That's because in addition to the normal capex in our existing units, we are also adding 2 more units in Nellore and Cuddalore, where we are investing for nutraceuticals and silica projects. So broadly, that's the investments in salt are captured within the overall regular investment. In terms of the other product categories, we are co-investing with our partners, and as the scale-up happens, we may even think of investing in our own manufacturing outfits for our other categories, which includes pulses and spices and other new categories which we may launch.
Broadly, give us a sense of FY19 revenue. How could that look like change going forward?
I think broadly we will track the performance which we had committed in terms of the continuing business. As far as the overall numbers are concerned, this year we will not see several one-offs. So we will not see the one-time income we saw on the fertilizer business sale, which happened last year. Also last year we saw the benefit of Trump tax reforms flowing through into the P&L. That won't be repeated this year. Barring that, we see fairly positive on maintaining our numbers and fairly positive on the consumer and specialty segment growing forward, moving forward with their profit growth.
Okay, Mr. Mukundan.